Home Depot stock, ticker symbol HD. Home Depot announced their quarterly results where they beat EPS by 9 cents and they beat the revenue also by a small margin. The stock is up almost 5% after earnings were released. So what happened, and does this mean that HD stock is a buy right now? In this video I'm going to show you real quickly what Home Depot does, a quick view at the earnings report, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price tag to see if Home Depot is a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about the stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Home Depot do? Home Depot is the world's largest home improvement specialty retailer, operating more than 2,300 stores in the United States, Canada and Mexico. When we dive into the earnings, we see that Home Depot did 43.9 billion in revenue, which is an increase of 2.7 billion or 6.5% year over year. Comparable sales increased 5.8% and the comparable sales in the US increased 5.4%. So to me, this looks very good. Revenue is increasing year over year, and one of the most important numbers for Home Depot, the comparable sales, are increasing as well. Net earnings were at 5.2 billion or $5.00 per diluted share, compared to a 4.8 billion or 5.53 per diluted share year over year, an increase of 11.5%. So basically it means that margins are increasing since the revenue is increasing at 6.5%. And the net earnings increases at 11.5%. So I definitely like this part. And this is also influenced by the inflation, of course, so keep that in mind. The company reaffirmed fiscal 2022 guidance of total sales growth and comparable sales growth of approximately 3%. Operating margin around 15.4% and diluted earnings per share percent growth to be mid-single digits. The last things in these earnings, which I think are very important, are the selected sales data. Customer transactions is down 3% year over year, and of course this is something that I don't like. The amount of transactions has decreased by 3%. But when you check the 6-month ended period, we see that it's at 5.5%. So this 3% is still not good enough to me, but at least it's getting better. The average ticket increased 9.1% year over year, which is also caused by inflation. But still, it's very good to see that this number is increasing. And on the 6-month period, we see that it increased 10.2%. So it means that right now, growth starts to slow down just a little bit. Sales per retail square foot is up 5.7%, which is very good, especially since it's significantly higher than the 6-month period of 4.3%. So I really like this part. And with that being said, it's time to dive in the historical returns to see what happened there. I decided to include the S&P 500 as a benchmark, and I added Lowe's as their main competitor. On the 5-year chart, we see that Home Depot had a total return of 128%, including dividends. The S&P 500 returned 92% and Lowe's returned 194%. So both companies outperformed the S&P 500 big time. On the 1-year chart, we see that Home Depot returned a -3% versus the S&P 500 at -2%. Lowe's returned 11%, which is quite a difference. On the 6-month chart, we see that Home Depot returned a -9.8%. The S&P 500 is at -3% and Lowe's is at -7.9%. So both companies underperformed the S&P 500 by a small margin. On the 1-month chart, we see that Home Depot returned 7.5%. The S&P 500 returned 11% and Lowe's returned 13%. So Home Depot underperformed again by both a small margin. So does this mean that Home Depot stock is a buy after today's earnings and based on the historical returns? Let's find out by checking the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. I also want to mention that I'm almost at 1000 subscribers, so please help me achieving this huge milestone by giving me a subscribe. In return, you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. Home Depot is a 340 billion market cap company, which makes them one of the bigger companies in the US. The PE ratio is at 20, which could indicate that they are around their fair valuation. The thing I really like is the fact that current PE ratio is way lower than the 5-year average, so this looks good to me. 12 trailing month revenue is at 16.5 billion, and in this graph we see that revenue went up quite nice and steady. During the lockdown periods it really took a big jump, so keep in mind that growth will slow down in the coming years. The 12 trailing net income is at 16.5 billion, which gives us a profit margin of 10.8%. The thing I really like here is the fact that current profit margin is above the 5-year average, even when it's this small. But earlier in this video we saw that they expect margins to increase, so I really like this part a lot. It's expected to be around 15%. Another thing that I really like about Home Depot are the return on assets, which is at 16.8%. So this is above the 10% minimum and looks good to me. Return on equity is something that I don't like, of course, so keep an eye on that number. The most important number here, return on invested capital, is looking really good at 25%. But keep in mind that this is lower than the 5-year average of 27%. But overall, 25% is still really good. A thing that I don't like is the ratio between cash and debt. Right now, total debt is at 48 billion, while operating cash flow is at 14 billion. Leverage-free cash flow is at 8 billion, and total cash is at 2.8 billion. So this is something to keep your eye on. Next to that, it's very important that free cash flow is growing, since this is used to pay down debt, of course, but also to buy back shares, pay dividends, do acquisitions, research and development. In this graph we see that free cash flow is going up quite nice and steady, with a big spike during the lockdown periods. So to me this looks very good, and as long as they pay down debt, I think you have nothing to worry about with the current debt. The next thing are the shares outstanding. You want this number to decrease over a longer period of time, since this will add a lot of value to the investor. EPS will go up and it will be easier to pay dividends, since total dividends paid will go down every time they buy back a share. On top of that, it will be easier to increase the dividends. So I really like this graph. In the past 5 years they bought back roughly 14%, which is quite a lot. And with the current stock price increasing, I'm really curious what will happen with the repurchase program, since you don't want the company to buy back overvalued shares. Next up are the dividends. Right now, dividend yield is at 2.4%, which pays you a $7.6 annually, or $1.9 each quarter. Payout ratio is at 45%, which is pretty okay. You want this number below 50%, so this looks really good. And with the free cash flow increasing and shares outstanding decreasing, I think this payout ratio will go down in the coming periods, which is of course a good thing. The 5-year growth rate is very impressive with 17.5%, so I really like this part. Next to that, they increased their dividends for 12 years in a row. So from a dividend perspective, this is a great dividend growth stock to me. The last part of this video will be about the 3 price targets. I'm using the Everything Money software to come up with 3 price targets based on a low, mid and high assumption. We have to fill in some key numbers, starting off with revenue growth. For the revenue growth, I expect things to slow down just a little bit, so I'm filling in 6%, 7% and 8%. Profit margin will increase in the coming periods, so I'm very optimistic and fill in 10% for the low assumption, 11.5% for the mid assumption and 13% for the high assumption. Free cash flow margin is a bit lower on the average, and I'm filling in 8, 9.5 and 11%. PE ratio is at 20 right now, but I want to pay a lower multiple since it will be harder for the Home Depot to grow at higher numbers. So I'm filling in 17, 18 and 19. It's the same story for the price to free cash flow. And I'm using these numbers because I think Home Depot is the biggest market leader in the industry. My desired annual return is 12.5%, since I can get an easy 10% average return with owning an ETF. Right now, Home Depot stock is at $330, with today's 5% increase included as of recording this video. I hit analyze and we see some green numbers. We have a low price target of $197 to $246, a mid price target of $260 to $315, and a high price target of $335 to $396. So if you believe these high numbers, then Home Depot is a buy. Personally, I think the most justified range is between $300 and $335, which means that right now there's not a lot of potential when you buy at these prices. My final conclusion on this stock is that I really like the company. And I do like the stock as well. It's very steady and consistent, and of course the biggest do-it-yourself retailer in the world. Dividends are really great and they buy back a lot of shares, which is also very good. But that is a bit too high. And at current prices, I think there's not a lot of potential in the stock price. So I'm still bullish on Home Depot from a dividend perspective. And from a value perspective, I think it's better to just wait a little bit longer for the stock price to come down and enter at lower prices. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.